Hello and welcome to this Magellan update, which is part of our In Review series for 2022. My name's Jennifer Herbert and I'm joined today by Gerald Stack, our Head of Investments and Head of Infrastructure. And today we'll be discussing why global listed infrastructure is worth consideration, particularly in the current market environment. Gerald, thanks for joining us today.
Thanks, Jen.
Gerald, there's a lot of volatility in equity markets at the moment. We've got a war in Ukraine, we've got US inflation at 40-year highs, and we've got interest rates still on the way up. So why is now a good time for investors to look at infrastructure assets?
Okay, so I guess the answer to that is kind of encapsulated in the famous quote from Benjamin Graham that in the short term, the stock market is a popularity contest, and in the long run, it's a cash flow weighing machine. All the issues you talk about, inflation, rising interest rates, the Russia-Ukraine war, these are all real issues, but we'd like to think that they're essentially short-term issues. In the long run, infrastructure is about, or the investment characteristics, investment attractiveness of infrastructure is about the cash flows that it generates. Now, infrastructure assets deliver essential services, the services that communities rely upon, the provision of water, the provision of energy, the provision of transport. And because they're essential, the demand for these services is highly reliable. In terms of the way we then define infrastructure assets are rarely going to face any competition. They'll face some limited competition potentially, but it's pretty limited. And so typically, these assets are highly price inelastic. That is, as you put up prices, there's limited impact upon demand. Reliable service, reliable demand, no impact to increasing in prices and limited competition. So that means ultimately over the long run, they deliver very reliable earnings. And those reliable earnings mount up year in, year out. And it's that delivers that weight of cash flow that means ultimately you get very reliable investment returns. So I would think in an environment of heightened uncertainty, that those reliable earnings are ultimately kind of attractive to investors, and that's the reason to invest.
Historically, when interest rates go up, like sharply, infrastructure asset trading prices tend to get hit quite severely. This seems to be a little bit at odds with what you're talking about. Can you explain that share price reaction?
So I think we've got to differentiate between two things here. What's going on with the businesses? What are the fundamentals of the business and what's actually happening in terms of value? So in terms of the businesses, our world divides kind of neatly into two parts, utilities and infrastructure. If you're a utility, you're providing water or energy. The way that utilities get regulated around the world is that the regulator allows them to earn a fair return on their capital, and that's typically around about the 10% mark. And so good times or bad, they're allowed to set the price for their service such that they earn that return. So as inflation or interest rates rise, they're able to put up their prices to recapture that such that they make a fair return on the capital they've got invested in the business. So as a result, in an inflationary or an environment where interest rates are rising, they're fundamentally protective. There might be a little bit of a lag. Inflation may go up before 6 months to a year before they put up prices and the like, but fundamentally they're protected. So that's the utility part of our universe. In the infrastructure part of our universe, it's typically price rather than earnings that gets regulated. So if you think about the toll you pay on a toll road or the charge you pay going through an airport, that toll grows with inflation over time. It's not earnings that gets regulated, it's the price that gets regulated. And as a result, if provided the underlying levels of volume, the number of passengers going through an airport, the amount of data going through a network, the amount of traffic going down a toll road, provided that doesn't change dramatically, then you're capturing inflation in the price, and you're at least, and your volume's stable. And if the economy grows over time, you're getting more volume as well. So in that environment, again, infrastructure is actually kind of well protected from an inflation type situation. So the fundamentals are well protected. That's at the profit and loss line. We also have to think about the balance sheet. There's typically a fair amount of debt in the capital structure. And these companies have taken the opportunity of the last decade or so to lock in very long-dated debt as what has been very cheap rates. As rates have come down progressively over the last 15 years, we've seen the tenor, the average debt maturity for the companies in our portfolio increase from something like 3 years on average, let's say, back at the times of the GFC, 2009, 2010, to today, the average debt maturity would be something close to a decade. So that is, they've locked in their average debt costs for about the next 10 years, and therefore rising interest rates should hold little impact for them in terms of their balance sheet. So the P&L and the balance sheet, kind of a nice space. So the fundamentals are unaffected for these businesses. So then it comes down to valuation. As you rightly say, over recent history, when interest rates have gone up, typically infrastructure values have fallen. There's been this knee-jerk reaction. But what we've also seen is that pretty quickly, infrastructure values have come back. And so you've got two different things going on. Again, I return to the Benjamin Graham quote. In the short term, it's a popularity contest. Investors tend to see these are long duration assets. They're concerned about inflation. Infrastructure gets hit. But in the long run, or the longer run, it's not even in the long run, in the longer short run, what we typically find is that infrastructure values come back because investors come to appreciate the stability of those cash flows and the inflation protection that they've got built into their underlying frameworks.
Thanks, Gerald. And you're always saying that infrastructure is an extremely boring asset class. If that's the case, then why do investors need Magellans' expertise in active investing rather than just going and getting an infrastructure ETF?
Yeah, so I think the key here is definition. So the way that we define infrastructure is that we see infrastructure as delivering very reliable earnings. As you say, I've said many times, it should be boring. It should be highly reliable and predictable to the point of being boring. And if you take that view of infrastructure, then what you want to do is you want to avoid things with oil price linkages, with sovereign risk, with competition. These are kind of exciting issues, but for an infrastructure investors, they're not wonderful places to be. So we want to avoid those type of topics. Now, if we look at the indices that are out there, and there are a number of different indices, and if we take all the stocks in the indices that are out there, we'd end up with around about 300 to 350 companies in the potential universe of stocks we could look at. If we then take Magellans' approach, what we do is to take that group of 350 stocks and we'll screen out anything that faces issues that mean that their earnings are not reliable over time. So we don't want to be in competition, so we're not going to be in power generation. The price of power, if you're a competitive power generator, fluctuates every minute. And that the price of power can fluctuate quite significantly, so therefore revenues and earnings are not reliable. So we're going to avoid those things. We're going to avoid anything with oil price linkages because trying to work out exactly where the oil price will be in 5 years' time is a complex issue, and it means that ultimately the values that we perceive in the energy infrastructure space can be pretty problematic. So we're going to avoid those companies, and we're going to avoid any company whose earnings have a material allocation to jurisdictions where we're not comfortable, where the right of law, the rule of law, doesn't protect us over time. So we're not particularly keen on investing in infrastructure companies in Russia or China. It doesn't mean that bad companies are indeed bad investments, but we're not confident that the earnings will be ours in 5 years' time, and therefore we're not confident in value. So we're going to avoid those things. So if we take all of those things out, what we're left with is highly resilient, highly reliable earnings, which to us is the bedrock of why people should invest in infrastructure. So we're left with, from that potential universe of 300 to 350 companies, we're left with about 130 to 140 companies whose earnings collectively are highly reliable and predictable. Now, it doesn't mean that every company will meet our expectations every single year, but taken as a group, we can be pretty confident about that group of companies will be pretty close to expectation, and therefore reliable earnings, predictable outcomes over time. So the difference between us and the indices, which is what you're getting in an ETF essentially, is one of definition and our commitment to be conscious of that definition and to remain boring, if you like. And it's that boringness that ultimately that we offer.
Gerald, thank you for your insights.
Thank you.
And thank you all for watching. If you have any questions, please don't hesitate to reach out to the Magellan distribution team, and feel free to share this update with clients and colleagues as you see fit. Take care as always.